This is a brief review of the concept of lower cost of market as it's applied to inventory. One of the basic principles of inventory is valued at the lower of cost or the market value of the product. So in some cases, inventory must be written down to some other value than cost, and we're going to say market. Subsequent to the fact that we realize that the inventory's utility, its probable future economic benefits, is less than what we paid for it, is less than its cost. Now, when we do recognize that that has occurred, it's recognized as a loss in the period that we realized the loss. Typically speaking, or practically speaking, a loss like this is usually part of cost of goods sold, but it should be reported separately if that loss is material. Another thing that's very important is once that item has been written down to market, it cannot be written up in subsequent periods. And also, now the cost of that item when it's written down is that written down amount is its cost. Now, market overall is the current cost to replace the inventory itself. Now, there's a ceiling and a floor to market, and the ceiling is market cannot exceed net realizable value, which is our current cost less additional processing or other costs associated with selling or disposing of the inventory items. There's also a floor. Market cannot be below net realizable value less an allowance for a normal profit margin. It's also important to note that lower cost of market may be applied to individual inventory items or to inventory as a whole. And at interim dates, lower cost or market need not be applied if we expect that there's actually by year end there will be no loss due to lower cost of market. But if there are losses from a non-type of temporary decline, it does have to be recognized on an interim basis. Now, the best way to do this is to do an example for lower cost of market. So let's take a look at this next slide. We have some information here where we have a cost of $100,000. We have replacement cost for that item of $82,000. So we paid $100,000. We can currently buy it for $82,000. Its net realizable value is $90,000, and there is a normal profit margin that normally would occur on this $100,000 worth of inventory of $5,000. So in this case, market is the cost to replace the inventory, and that's going to be $82,000. Now let's take a look at the ceiling and the floor. The market cannot exceed net realizable value. In this case, our net realizable value is $90,000. The floor, market cannot be below net realizable value less an allowance for a normal profit margin. So we have our net realizable value of $90,000 minus a normal profit margin of $5,000, meaning our floor is $85,000. So our cost to replace the inventory is $82,000. So the thing is, we normally, if it was within the ceiling and the floor, we would basically leave the market at $82,000. But since the market is below floor, we can't go below the $85,000, basically the net realizable value less an allowance for the normal profit margin. So in order to measure our loss under lower cost of market, we would take the $100,000 historical cost, subtract out the $85,000 floor, which we'll call market, means that we end up with a $15,000 loss. And if this was just a minor item, a non-material item, it would be debit cost of goods sold $15,000 and a credit to inventory $15,000. If it was a material item, it would be a debit as a loss from inventory write down and a credit to inventory. Now, with that said, let's take a look at number one. And this is a theoretical problem regarding lower cost to market. And it says, which of the following statements are correct when a company applying the lower cost of market method reports its inventory at replacement costs? You have two statements. Number one, the original cost is less than the replacement cost. Number two, the net realizable value is greater than replacement cost. So again, do your analysis, stop the video, and when you're ready, go ahead and restart the video. Okay, the answer to number one is B, 2 only. And the answer here is market is equal to current replacement cost subject to ceiling, and the minimum is net realizable value less the normal profit. Okay, now let's try number two. Number two, again, Swiss Magic reported coca inventory at $50,000 due to recent price changes, and these price changes appear to be permanent. The replacement value of the inventory is $40,000. Management estimates that the process to refine the coca will take $15,000. Once processed, the raw coca can generate $45,000 in sales. The company normally earns a 10% profit margin on the refined product. What inventory value for the coca inventory should Swiss Magic report at year end? So go ahead, look at the problem, stop your video, and when you're ready for the answer, go ahead and restart. Okay, number two, the basically what inventory value for the coca inventory should Swiss Magic report at year end? In this case, the answer is B, $30,000. And if we see here, market is the current cost to replace the inventory, so that's going to be $40,000. If we take a look at the floor would be basically cannot be below net realizable value less an allowance for normal profit margin. Our net realizable value in this case was equal to the $30,000. Okay, let's take a look at number two. In this case, we have a company that has cocoa inventory. It has a cost value on its books of $50,000. And due to recent price changes, which appear to be permanent, they could buy the cocoa now, replace that cocoa in their inventory at $40,000. Now, the cocoa in their inventory still cost money to refine, and management estimates that the process of refining the cocoa will take an additional $15,000. And once it's processed, this cocoa mix can generate a $45,000 in sales. And the company normally earns a 10% profit margin on the refined product. So what inventory value for coca inventory should Swiss Magic report at year end? So again, go ahead and stop the video. Okay, let's take a look at number two. What inventory value for the coca inventory should Swiss Magic report at the year end? And the answer is B, $30,000. Let's take a look at the ceiling and the floor here. Market is a current cost to replace the inventory. So the current cost to replace our inventory would be $40,000. So in order to be $40,000, that we can't exceed, that $40,000 can exceed the net realizable value or the floor with the net realizable value less allowance for normal profit margin. So let's take a look at what happens. The market cannot exceed net realizable value. Now, net realizable value is the estimate of the selling price in the ordinary course of business less the cost of completion and disposal. Now, what you think is basically the selling price is going to be $45,000 minus the cost of completion and disposal. We said a $15,000 refining of the coca, which means that the ceiling is set at $30,000. Okay, the market the floor of the market cannot be below net realizable value less an allowance for a normal profit margin. Okay, our net realizable value was established up here, $30,000 minus a normal profit margin here of 4,500, which comes from our 10% profit on 10% profit margin on $45,000 of sales. So it's 30,000 minus 4,500 means that the floor would be 25,500. So in this case, the market exceeds the ceiling amount, so we would use the ceiling amount of $30,000, and that is the answer. Okay, let's take a look at whoops, sorry, there is no number 3, so that is it for lower cost or market.